And in efforts to boost participation of its electric cars in portfolio, US automaker Ford is now ramping up investment in zero-emission cars. By 2030, it expects 40% of its vehicles.
July 24th, 2024. Ford executives open an earnings call they clearly don't want to be on. On the other side of the line are angry investors and skeptical analysts. Ford has missed Wall Street's expectations. The stock is tumbling its worst single-day drop since the 2008 financial crisis. And hanging over everything is one terrifying number: over $100 billion. This was supposed to be Ford's comeback era. A few years ago, leadership promised transformation, a leaner company, a smarter company, an EV-first future that would finally drag Ford into the modern age. But the market isn't buying it. One Morgan Stanley analyst cuts straight through the optimism. "You said Ford is a completely different company than it was 3 years ago." The stock market doesn't seem to agree. After a barrage of criticism, CEO Jim Farley finally speaks. The EV journey has been humbling. Ford had bet nearly $100 billion on electric vehicles, and now, quietly, they were pulling back. So what happened? How does a company that sells America's best-selling vehicle end up here? And why does Ford look healthy on the surface while quietly unraveling underneath? At first glance, Ford doesn't look like a company in trouble. In fact, the numbers look good. After the pandemic crushed the auto industry in 2020, Ford's revenue snapped back hard. Annual sales climbed from roughly $127 billion in 2020 to $137 billion in 2021, then $158 billion in 2022, and finally $176 billion in 2023. That's real growth, especially in a brutally competitive, saturated industry. If you stop there, you'd think Ford was doing just fine. But revenue isn't the business, it's the top line. What matters is what's left after everything else is paid. And that's where the story breaks. As revenue climbed, Ford's profitability began sliding in the opposite direction. Operating income bounced around, briefly recovered, then quietly started deteriorating again. Quarter by quarter, margins tightened, costs crept up, confidence faded. By late 2023, Ford had sunk to 494th place in the S&P 500 by profitability, almost falling off the index entirely. More money was coming in, less money was staying. That contradiction is what set off alarm bells on Wall Street. And once you look at Ford's balance sheet, the reason becomes impossible to ignore. Debt. By 2023, Ford was carrying close to $150 billion in total debt. Its debt-to-equity ratio climbed above 3.5, meaning it owed more than 3 times what shareholders actually owned. For comparison, Toyota sat near 0.6, BMW around 1.1, the industry average hovered close to 1. Ford wasn't just leveraged, it was stretched, and the most unsettling part, this wasn't new. Even before the pandemic, Ford was already drowning in debt. They briefly pulled it down in 2021, then watched it creep right back up again, which raises a dangerous question. If Ford's core products still dominate the market, if revenue is rising, why does the company feel like it's sinking? That answer starts with the bet that was supposed to save them: electric vehicles. For most of the 2010s, Ford watched the electric vehicle boom from a distance. Tesla was loud, startups were flashy, concepts came and went. Ford didn't rush. They experimented, ran small pilots, and treated EVs more like a research project than a revolution. Then, quietly, everything changed. In 2017, Ford created a dedicated internal unit called Team Edison. The mission was simple but ambitious: build a serious electric vehicle, fast, not a concept, not a compliance car, a real product. 2 years later, Ford made its move. In November 2019, they unveiled the Mustang Mach-E. The reveal felt more like an Apple event than a car launch. Sleek design, big screens, a legendary name repurposed for a new era. And for once, Ford wasn't late. They were early, but the Mach-E wasn't the real gamble. It was a test run. Ford's true masterstroke came in 2021. Instead of designing a futuristic EV that looked nothing like a traditional car, Ford did something radical. They electrified the most successful vehicle in America, the F-150. For over 4 decades, the F-Series had been the best-selling vehicle in the United States. Not EV, not a truck. Vehicle. It was Ford's golden goose. Touching it was risky, but not touching it was riskier. So Ford cloned it. The F-150. Lightning looked familiar. It drove familiar. It felt like a normal truck, except it was electric. No weird design, no learning curve, just the same product millions of Americans already trusted. And it worked. The Lightning became the best-selling electric pickup in the country. The Mach-E outsold it. And suddenly, Ford was the second largest EV seller in the U.S., behind only Tesla from the outside. This looked like a win. The media cheered, analysts praised the strategy. Ford looked like the legacy automaker that had cracked the EV code. But the numbers tell a colder story. In 2023, Ford sold nearly 2 million vehicles total. EVs accounted for just 64,000 of them. That's barely 3%. And here's the problem. Those 3% weren't making money. They were bleeding it. Ford had already poured billions into battery plants, EV factories, and new supply chains. Over $11 billion into battery facilities alone. Nearly $2 billion in Canada. Another €2 billion in Germany. By 2022, Ford publicly committed $50 billion to EV development. All of that spending was for a tiny sliver of their sales. Ford wasn't just betting on EV growth. They were front-loading the future, assuming demand would explode fast enough to justify the cost. For a moment, it looked like it might, then the market shifted, and Ford found itself trapped in a war it could never win. Ford didn't fail at building EVs, they failed at making EVs make sense. By 2022, the electric vehicle market flipped overnight. What had looked like a gold rush turned into a price war. It started with Tesla. Facing intense competition in China, Tesla slashed prices, first a few percent, then more. Model 3, Model Y, cut after cut. Tesla could afford it because they were vertically integrated, massively scaled, and already profitable. But once Tesla moved, everyone else had to follow. Ford didn't want to cut prices, they had to. The F-150 Lightning saw price reductions as high as $7,000. At the same time, battery costs were still elevated. Supply chains were tight, and labor costs were rising. Every lever Ford pulled made margins worse, and this is where the illusion shattered. In early 2024, Ford disclosed that its EV division had lost $1.3 billion in a single quarter. Do the math, and it gets absurd. Ford was losing roughly $130,000 per EV sold, not per model line per vehicle. That meant every Lightning or Mach-e leaving the factory made the company poorer, and things outside Ford's control were piling on. Governments began pulling the rug out from under EV demand. Germany ended its EV subsidies in late 2023. France, Sweden, and New Zealand followed. In the US, political pressure began mounting to roll back incentives altogether. EV adoption slowed, buyers hesitated, inventory stacked up. Ford had spent tens of billions preparing for a future that suddenly wasn't arriving on schedule. By mid-2034, the retreat began. Ford cancelled a planned electric SUV. They scaled back EV production targets. They cut EV spending from 40% of capital allocation down to 30%, and they began writing down EV investments as losses. For the full year, Ford's EV unit lost about $5 billion. The company expects roughly the same loss again. This is the trap Ford fell into. They couldn't abandon EVs. Too much money was already sunk, but they couldn't push harder. Every additional unit made the losses worse. They were stuck funding the future while being crushed by the present. And just when it seemed like EVs were the core problem, a much older, deeper issue resurfaced, one that had nothing to do with batteries, charging, or the future at all. That's where this story really turns. EVs didn't create the crisis, they exposed it. Long before battery plants and charging networks, Ford had a problem that never went away. And quality problems don't just hurt reputation. Ford has been recalling cars at a rate that's borderline unreal. In 2020, they recalled around 700,000 vehicles. Painful, but survivable. By 2024, that number had exploded into something else entirely. In a single year, Ford issued 37 separate recalls, 2 million Explorers, hundreds of thousands of other models, electrical systems, cameras, software, powertrains, and then came the penalty. The U.S. government fined Ford $165 million for slow recalls and inaccurate reporting. Not because mistakes happened, but because Ford failed to act fast enough once they knew. That fine wasn't about defects, it was about systems failure, and the cost curve tells the real story. Even worse, Ford's defect rate spikes 70% after launching a new model. The industry average is around 20%. That means Ford struggles most precisely where modern automakers must excel. New platforms, new electronics, new software-heavy vehicles. This is where EVs made everything worse. Electric vehicles are not simpler, they are more complex. More software, more sensors, more things that can go wrong. Ford poured tens of billions into EV infrastructure while their core manufacturing discipline was already strained. Instead of fixing the foundation, they added another flaw. And the cracks widened. Here's the irony that drives investors insane. The Ford F-Series is still America's best-selling vehicle, 4 decades running. The brand is iconic. Demand exists. The revenue is there. But profits leak out through inefficiency, rework, recalls, and warranty cost. So even as revenue climbs, profitability sinks. That's why Ford fell to 494th on the S&P 500 by profitability, nearly off the list, despite being one of the most recognizable companies in the country. Ford isn't broken because it chased the future. It's broken because it chased faced the future before fixing the present. On paper, this should be a success story, an iconic brand, the best-selling vehicle in America, rising revenue in a brutal industry. But underneath that surface is a company bleeding through inefficiency, recalls, and decisions that piled complexity on top of unresolved flaws. EVs didn't ruin Ford. They forced Ford to reveal what was already there. Now the company is standing at a fork in the road. One path is hard, slow, and unglamorous. Fixing quality, tightening operations, restoring discipline, and earning back trust the boring way, one vehicle at a time. The other path is easier to sell but far riskier. Keep chasing narratives, keep spending billions, and hope the market forgets the fundamentals. Ford has survived more than a century. It survived oil shocks, recessions, and competitors that vanished completely. It's the only major American automaker that never went bankrupt. But survival in the past doesn't guarantee survival now. Because this time, the threat isn't external, it's internal, and the real question isn't whether Ford can build great cars again. It's whether Ford is willing to slow down, face the rot, and rebuild from the inside before the market decides the story for them.